part of the Black-Scholes model is volatility. So volatility kind of feeds into the price of these option contracts. And when volatility is very high, the premiums of both puts and calls go up.
With everyone seemingly running around like headless chickens at the moment, given the current state of inflation, interest rates, consumer confidence, and economic growth, everyone is scratching their heads and wondering how should they be investing their money right now. And recently, while in the US attending the Berkshire annual meeting, I got the chance to sit down with Matt Peterson from Peterson Capital Management, whose portfolio has returned an 18% annualized return since 2011. And in that interview, we discussed how Peterson approaches investment, including a strategy that value investors can use to improve their returns. Shout out to Tom, who hosted the discussion with Peterson, and if you want to see the full interview, you can over on the Investing with Tom podcast YouTube channel. Today's video is sponsored by ShareSite, which is the portfolio tracking software I use to accurately assess my portfolio's performance. Sign up for a free account or get 4 months off a yearly subscription by heading over to sharesite.com/Hamish Hodder or by using the link below. First, in the interview, we spoke about how to allocate cash in a portfolio, in particular, how to deal with the cash inflows that are coming into your portfolio that may be out of your control. And we're talking about this in the interview in the context of an investment fund that Peterson runs and cash coming in from new investors adding money to the fund. But the same kind of principles can be applied to someone who is setting aside money regularly from their income to invest in the markets. How should you approach putting that cash into investments in the stock market?
But we have a modest sized fund, right? There's 20 million-ish. So if we say have a new LP that joins and puts in $3 million, we can be really patient with that capital. So there's nothing that's putting pressure on us to buy. But we have these compounders that I know extremely well. And one or two of them might be inexpensive and it will allow us to allocate additional capital. So we can allocate capital to the positions we already own, or we might be watching some new positions and allocating there. But it's very, very easy to allocate 3 or 5 million to a good position, especially when you're selling a put, which gets kind of magnified, 100x, because every contract represents 100 shares.
Yeah.
So it's quite easy. It doesn't take long to allocate capital, but we can be very patient. So even a 3 million, suddenly we have 15% cash or something. That's not an anchor for us. And within a few months, or even if it takes a few quarters, that will get allocated to a good investment opportunity.
There's really 2 key takeaways from this clip. The first is that you want to be patient as an investor. So don't think that you have to, that second that money comes into your portfolio, immediately deploy it into the markets. You can be patient. Now, in Peterson's view, you don't want to be overly patient. I'll talk about that. That's the reason, kind of number 2, as to why you don't want to be waiting many years to invest money in the markets. But essentially, if it takes a few months, or he says even a few quarters, so that kind of implies up to a year, for example, to deploy money into the market, that's okay. It's better to be patient and make sure that you have a good investment opportunity somewhere that is where that money is going to actually be used effectively and generate you a significant return. The second takeaway from that is that there's always opportunities in the market somewhere, right? As an investor today, you have access to information and access to invest in thousands of global companies in different countries, in different regions, different size businesses, different industries. All different types of companies are available to you. So there are always opportunities available somewhere in the market. So if you are completely actively managing your portfolio, your own portfolio, looking for individual businesses, then you really need to be on top of looking for these ideas. And Peterson also, we didn't discuss it in this podcast, but he also talks about how he uses 13 Fs of famous investors or successful investors as a way to farm ideas. And I actually spoke about this in a recent video if you want to check that one out after watching this. We'll also circle back in this video and talk about where the potential investment opportunities are right now in the markets. But before we get to that, Peterson had something to say about Warren Buffett and Berkshire Hathaway's cash position, which is obviously getting or has been growing considerably over time. Although he did deploy a lot of money into the market in the last quarter, he still has over $100 billion sitting on the sidelines. And he answered the question as to whether investors should use that as a signal to have cash waiting on the sideline in their own portfolios.
His cash position, he's playing an entirely different game. Yeah. If you look at even Daily Journal where Munger is running the portfolio, they're just fully invested. And Munger even pointed something out at the Daily Journal meeting where he said he's never in his life, he's 98 years old, he's never in his life sat around with cash waiting for an opportunity. So even if you're dealing with many millions and even tens of millions, I think even beyond hundreds of millions, you should be putting all your cash to work.
So where are the opportunities to invest right now? Well, there's a lot going on in the markets right now or in the world, specifically related to the stock market and the economy, but other things as well that are impacting the economy. And all of these things are creating a significant amount of fear and uncertainty. And that is where opportunity lies when investing in the stock market. And when all of this is going on, just because markets and stock prices are coming down doesn't necessarily mean that businesses or stocks are actually cheap, right? There's certainly a lot of justified decline in stock prices that we're seeing at the moment, particularly if you look in the unprofitable tech sector. There's a lot of businesses that have been smashed by 80, 90%. And a lot of that, honestly, is probably justified because those businesses were essentially a speculative investment on potentially being profitable some point in the future. And when interest rates rise, essentially because business values are the discounted future cash flows, the further out those cash flows are, which is very far for businesses that are not profitable, the more of a decline in value that comes from rising interest rates. So there's a significant amount of the decline in stock prices that is certainly justified. But within the fear and uncertainty that's going on at the moment, there are certainly going to be opportunities where business prices get sold down further than they deserve to be.
Fear and greed, just the herd mentality just pushes even billion and almost trillion-dollar businesses to extremes. So they've been able to find these opportunities. But certainly it's much, much easier if you're dealing with small cap companies that are less scrutinized than, something like even an Activision or some large cap. It's just, they just tend to be much more frequently mispriced.
Peterson believes that smaller companies have less analysts, less funds watching them, so are more likely to be mispriced. So one approach can be to look for smaller businesses that have less scrutiny attached to them, and there's potentially more opportunity for those businesses to be undervalued and offering an opportunity. But given what we're seeing right now, where we're seeing a really broad sell-off in businesses and broad economic pain, that means that even large businesses, even in the billions of dollars in market cap, in value, even in those businesses, there are showing some significant opportunities to invest and make a high return over time without taking significant risk. Peterson then goes on to explain his strategy for using options contracts as a part of his long-term value investing strategy.
Part of our strategy is to purchase things for the lowest price we possibly can. And so we use a structured value approach where we write a put as a tool to own the underlying equity. Part of the Black-Scholes model is volatility. So volatility kind of feeds into the price of these option contracts. And when volatility is very high, the premiums of both puts and calls go up because there's more uncertainty. People want more premium for the perceived risk that they're taking. The way that we use these is very different than the way that most of the market uses them. So as people are speculating or trying to sort of buy a call to sort of leverage their gain, or they're trying to buy a put because they're scared of a security, so they're buying a put when they're fearful and they're buying a call when they're really euphoric. We're taking the opposite side of that trade.
Buying a put option contract gives you the right, but not the obligation to sell your shares at a fixed price before an expiration date. So what some people do is they use this to protect their downside risk when they are invested in a business. So essentially, you can think of it as insurance, right? So they have this, they have ownership of stock in a particular company, XYZ company, and they are worried that it's going to fall down significantly during this crash. So they buy a put option contract, which gives them the right, but they don't have to, just the right, if they need to sell the shares at a fixed price. So if the stock falls well below that price, they're protected, right? They have this insurance policy that says they don't have to sell down here, they can sell here. And for that put option, for the option and basically that insurance, the buyer is willing to pay a premium. They pay for that contract, for that option. Writing, or in other words, selling a put option contract, is the other way around. It's being on the other side of that trade. So when writing a put option contract, you are collecting a premium for giving someone the right to sell their shares to you at a fixed price in the future. So what happens when a stock is falling a lot is there's a lot of fear and uncertainty around that stock, meaning people are willing to pay higher premiums essentially for that put option insurance policy. And this means that potentially in some circumstances, this will give you the opportunity to use writing put option contracts to invest in a business at a price lower than it ever would be listed in the public markets. So let's run through a quick example just to visualize this. So let's talk about Netflix. This is a complete hypothetical example. This isn't a real example, but Netflix is currently at $190 per share. But let's say that I personally had a margin of safety price of $150. So I only wanted to pay a maximum of $150, but it's currently trading at $190. Currently, put options going out 12 months with an expiration date in 12 months offer a $40 premium for a $190 option, which means if I wrote this put option for somebody and collected $40 in premium, and then in 12 months time the stock was under 190, let's say 185, then I would be forced to buy at 190. But I've collected $40 in premium, meaning my net cost for the stock would be $150 per share, even though the stock never reached $150 in the market. And on the flip side, if the stock price did go above 190, I would just keep the $40 premium and I would never own the stock, which would mean I would earn a 27% return on my collateral over a 12-month period. Now, it's important to note that this is an advanced strategy that probably shouldn't be done by the vast majority of people, and certainly shouldn't be done unless you have a complex and deep understanding of how derivative contracts work in the markets. Some of the most obvious risk or mistakes that you could make with really having little understanding of how these contracts work is if you wrote or sold put option contracts without having cash as collateral sitting somewhere to cover that put option contract. Because remember, as the buyer of the put option contract, you don't have to execute that contract. You have the right, but not the obligation. But as the writer, if the stock falls below the strike price, you will be forced to buy the stock at the strike price, meaning if you don't have the cash sitting around, then you won't be able to satisfy that contract. The other important factor is that the underlying business needs to be one that is great and that is worth far more than the strike price on the options contract, right? This is a strategy that can only be used or should be used in combination with value investing, because ultimately, if you write a put option with a strike of 100, but the stock's actually worth 50, then you're going to be paying more than what you're going to get back from that investment over time. And even worse, if the stock goes to zero, then writing a put option contract on that stock essentially means that you will lose all of the collateral that you put against it. And then on top of those risks, there's really 4 key outcomes that you should think about as to what could happen once you write this put option contract. So the first outcome, which is the worst, is that you're wrong about your investment and the stock goes to zero. In this circumstance, while yes, of course, you will lose the collateral, you'll be put the shares and you will have to outlay the collateral that you had set aside, and you'll have to buy the stock at the strike price. Because you have collected a premium, you will have outlaid, or you'll lose less money than you would have if you didn't write the contract and you just bought the stock in the open market. So it does kind of protect your downside to some extent. The second outcome is that the stock price is just below the strike price when the contract expires. In that case, you will be put the shares, but because you have collected that premium, it's likely that you will immediately make some kind of positive return on the stock. And in many cases, you may have actually bought the stock at a net price that is lower than the stock price ever got to in the open market. Outcome number 3 is that the stock price finishes just above the strike price. So that means you don't get put the shares, you just collect the premium. So you never actually owned the stock. And this is why you only want to do this, first of all, when the stock is near your margin of safety price, but certainly only if the premium offers you a good enough return, if you don't get put the shares. And then outcome number 4, which is the second worst, is that the stock price shoots up way above your strike price. And why is this the second worst? Well, you won't own the shares, so you don't benefit maybe 100% gain or whatever it is that the stock price goes up. You will have only that fixed return for collecting the premium. So your upside would be limited in that way if the stock price surged. Personally, this isn't a strategy that I currently use in my portfolio. It's just something that I'm learning about and that I find really interesting. So I wanted to share it with you guys. As I mentioned, if you got some value out of this video, make sure you hit that like button and hit subscribe. If you want to see the full interview, you can over on the Investing with Tom podcast YouTube channel. And also, I'll give a quick shout out to Brandon from New Money, who also did a really, really good video covering the complete option strategy. I only went into kind of half of it here. If you want to see the complete thing, then I'd recommend you go check out his video on his channel. I'll leave links to everything that you can watch after this down in the description below.